Hello, everybody. Thank you for joining us for today's public webinar. Good morning, Jim.
Good morning. Good morning. You've all heard me say this before if you've been with us. We do these in order to draw attention to our educational programs. The next educational program, I believe, starts February 21st. It's our key program, the intensive. The intensive, you have to have completed either a previous intensive or the foundational e-course to qualify for that. We'll do more on the intensive here in a little while. This intensive will be, in my estimation, it's probably going to be the most updated one we've ever done. And the reason for that is that I swore I would never write another book, but I am writing another book. And you know, it's really a lot of things that when I first wrote Mind Over Markets and then Markets in Profile, I really hadn't dealt a lot with clients, and I've learned a lot about, you know, what your interests are, how to communicate with you, and so that's going to make it quite a bit different. But before we do the hard commercial, there's a couple of things that I think are interesting. There's a new book out. The name of the book is The Biggest Loser Wins. Trader in London, Tom.
You mean the best loser wins?
Oh, The Best Loser Wins. I don't personally, I don't think the book's well edited in there, but there is some really relevant, important information. I don't think it'll teach you how to trade, because I certainly couldn't trade the way he trades. And I don't think many people can. It works for him, and that's fine. But he's got some really great information in the book. For years, I have been saying one of the worst things a trader can ever do is fade a trend day. And I knew that. I knew that from Stottlemyre. I knew it from myself and my observations. But I really didn't have any statistics to back it up. He has backed it up with statistics that he's gotten from the London markets. And it's amazing in there how many people, you know, can't resist shorting the trend days. And of course, that's just a killer in there. The other thing that I didn't know, at least I didn't even come close to the figures that he was talking about. When I had the discount futures brokerage firm, I knew that the average account, you know, lasted 7 weeks. So I mean, I knew the disastrous level. But one of the things that he really brings up that is fascinating is that short-term traders, about 61% of them have winning trades, but 90% is the number he uses, lose money. And the reasoning behind it is that we don't let our winners run. The win to loss ratio that at least the numbers he had, where, you know, traders lose about $1.6 for every dollar they make. And of course, that's going to give you, you know, a loss over a period of time. Excuse me. But the failure to let your profit run is huge. For those that are signed up by Saturday for the intensive that we're doing in February, I'm doing a seminar, an hour-and-a-half seminar on Saturday morning, talking about monitoring for continuation and letting the trade come to you. And of course, the monitoring for continuation, hold on one second. I'm sorry. Hold on. I just got a tickle in my throat. And of course, the monitoring for continuation ties right into the 1.6 loss for dollar gain, because even though they make more winning trades than I imagined, but the failure to stay with them is there. It's interesting as you read some of the research on that. It is just we let our losses run because of the hope that it's going to come back and break even. And I've known for years, people take exceptional risk in order to break even. I would like to say I'm not guilty of that, but I won't say that. And then the other side of the coin is that when we do have a profit, we get to be so afraid we're going to let that profit get away from us that we end up taking the profit too early. And of course, that actually does us in. Okay, now it's just a recommendation. Like I say, I would read the book. I think there's a lot of good information in the book. The numbers this morning, and I guess that this is interesting. I have a very negative personal bias on the market. But my position coming into this morning was long, hedged, but slightly hedged to the long side. The point is, and this is so important when we have these biases, what is important in the market is not what we think and not what our biases are. It is what are the other people in the market doing. If enough people in the market think the market's going up, the market's going up. If enough people think it's going down, it's going down. And a lot of short-term traders, they're looking at what's right in front of them. They're trading, right over the windshield. What's right in front of them right now. The trend is up. We had an upside breakout last Friday. The trend is up. Whether I think the trend is good or strong or not, whether I think the market's overbought, that is irrelevant to a short-term trader. And so now, coming into this, when looking at the market, the numbers this morning were fairly strong. So again, they took the market up. But why did I come in slightly long when the numbers were coming out today? You would normally say, well, want to be neutral. But I came in slightly long because, one, the trend is up. Secondly, there is no excess at yesterday's high. Now, I keep the profile in 2-tick increments, but there's no excess on that. Value was higher. And as the market broke yesterday, it was really, really difficult to get the market to trade lower. So it wasn't like, wow, it was obvious that there wasn't a combination of short-term selling and new money selling. It was mostly liquidation from, those that had gotten long during the day. And it's to be potent as a short-term trader, you have to constantly be aware of what is the market doing. Okay, now, what made the market pop this morning? Now, we don't know what it's going to do once we open, but this is the pre-market opening. Like I said, no excess on yesterday's high, higher value, and the tempo was very slow going down yesterday. But now, take a look at this. Tomorrow, what was positive for the market today may in fact be negative for the market tomorrow, because tomorrow is PCE. And as we talk about, that's the Fed's, most prominent gauge for judging in inflation. And the FOMC, that's what they use to judge inflation. With the numbers being strong this morning, it increases the odds that we get a stronger than anticipated PCE tomorrow. I don't know if that's going to happen. I'm just saying, when I look at this market, I always want to be aware of what is coming up. And I do know tomorrow's that's the big number tomorrow. Now, The other thing is what brought the market down yesterday, I think, was a week bond auction. And of course, that interest rates rose. Now, today at, I think it's 1 o'clock Eastern, you have a 7-year auction. Now, maybe because yesterday's auction was bad, they backed that auction up enough that it'll be successful. But historically, the 7-year auction, it's kind of a strange expiration. So there have been times when that has been a difficult auction. So again, I don't know what it's going to be, and they may have been prepared for it because yesterday wasn't that good. But just be aware that that comes up at 1 o'clock Eastern. And those are things, information as a short-term trader you should have in front of you, because that's just like any other economic release, because so much interest is spent on the fixed income markets right now. Okay. Let me take a couple of questions. Then I'm going to do a commercial. Then we'll come back to the markets.
Okay. Somebody's asking, Jim has said that intraday inventory imbalances drive price movement. How do we know when intraday inventory has gotten too long or too short?
Well, nobody rings the bell. You've just got to be able to observe the market. Now, let's take for an example, yesterday. If you look at yesterday, these are little clues. Right here is half back from overnight. Look at the early morning pullback low. The early morning pullback low came to the tick of half back from overnight. That is only one data point. But one of the things that caught my attention yesterday was the fact that it went to that exacting level and then rallied, for several periods from there. But what I was carrying forward, it's only one data point, but the fact that it took the traders to buy from exact level was more of an indication that they came in and they took it up from there, that it was weaker hands traders. So it's a combination. It's not only inventory getting too long on a short-term basis, it's what kind of inventory. More than likely, it was the shorter term traders. So the shorter term traders, have more potential to jump out faster than the longer term buyers. Longer term buyers, with the exception of maybe some systematic traders, seldom buy at these exacting levels. So there is nothing perfect, but you have to understand the market. You have to feel the tempo of the market. Just as I said, when the market went down yesterday, the tempo going down was slow, and tempo is pace. I can't teach tempo. You have to learn it from observation. But the fact that the tempo was so slow going down said it was really weaker sellers. Had we had a combination of liquidation from day time frame traders and new money selling, we would not have hesitated so much coming down. We would have gone down much sharper. Okay, another question.
Okay. Given that we had such a run up since the low, would you want to see good excess to indicate getting short, even though the previous all-time high had no excess? No excess plus mechanical 4900 SPX I took as simply profit taking yesterday.
Yeah, well, it was profit taking yesterday, but it was, like I say, it was triggered, I believe it was triggered by a poor bond auction. It took something to trigger that. But again, like I say, it just, the most important thing as a short-term trader is going to be the trend. The trend is up, and the next thing is value. Following value, then the next thing is, well, maybe it's first, but you're looking to see how much confidence is there in the market as the market opens. And you want to feel that confidence. When that market came down to exactly half back, that's not the highest level of confidence. Okay, one more question and then we're going to do a commercial.
Okay. On the most recent week ahead segment, Jim, you mentioned the afternoon pullback low from last week as a level above which the rally remains intact. Does Jim still see 48.60 as an important level?
Yes. Yeah. I mean, that's one thing, but it's, if it goes down to 40, 48.60, how does it get there? That's what it's one thing. One of the things I talked about, I said, read the book, The Biggest Loser Wins.
Best
One of
loser wins.
the best loser wins. I'm sorry. But one of the things that's interesting, they said, if you look at his charts, he doesn't have a single indicator on his charts. And so many times we get indicators or we get prices in our mind and we get fixated on those. And we get away from feeling the flow of what is going on in the market. Okay, Jen, I'm going to let Jen do the commercial, and then we'll come back and talk a little bit more about markets and take a couple of questions.
Okay, 1 second. I'll take the screen back. Okay, can you see my screen?
Yes.
Yep. So I see I see a lot of new names here with regards to joining us for this webinar. So I always like to just point out a few things in case you are new to us. Our official Twitter X account can be found here on our website. You go jimdaltontrading.com, and our YouTube. You heard somebody mention the week ahead. That's a video that we put out weekly, generally speaking, on Sundays. And if you want to subscribe or check those out, you can go here. We also put our public webinar recordings on our YouTube channel now as well. So if you're ever looking for additional content or you happen to miss one, or you want to go back and watch old ones, you can find that here. But as you can see, the intensive is featured up at the top. If you go to top navigation and courses, you'll see we've got all the information about the intensive posted here. We also have the schedule posted. It's an Eastern time, so you'll have to convert it for your time zone. But this gives you an idea of special topics and things that we'll be going over in the intensive. For those of you new, we designed this live course to be 4.5 weeks for a reason. It's so that you have enough time to be with us, see how Jim is looking at the market, see what things are repetitive, which things are have variation. We always say repetition with variation is very important. So we're covering quite a lot, and like you heard Jim say, this will probably be the most updated intensive simply because he is working on that book that he said he was never he was never going to write a new book. So I know a lot of people are excited about that. Just a couple of things to mention. So in order to be able to join us for the intensive, you do have to have the prerequisite requirement of the foundation and application of the market profile e-course. Right now we have discounted bundles, so you get a discount for purchasing more than one course. The only other way to be able to qualify and join us for the intensive is if you are somebody who has taken an intensive with us in the past and we can verify that, then you can be grandfathered in order to be able to join us. Also wanted to mention that our bundles are only going to be available through February 11th, because then that just gives you roughly 10 days to be able to complete that requirement in order to be able to join us for the intensive. So something to keep in mind, that if it's something that you're wanting to do and you need to do that prerequisite requirement and you'd like to get a discount for purchasing more than one course, buy this bundle, and you need to do it before February 11th. Our current sale pricing for the intensive of $1,399 ends this Sunday on January 28th. If you have any questions, specific questions about our courses, what's right for you, by all means, shoot us an email at jimdaltontrading.com, or you can give me a call at 409-422-7250. Just also, the other thing to mention is all of the webinars from the intensive are recorded. And when you purchase an intensive with us, you have access to the materials for 1 year after the course finishes. Because it's so webinar heavy, we want you to be able to have time to go back and review things. We highly recommend that. So It's also convenient for clients that have a day job, won't be able to join us for every live webinar, or you live in a different time zone for which it's not conducive for you to be able to join us for every webinar live. Okay. Jim, I will give you back the screen. Jim, I think you're on mute. Jim? Can you guys hear me? I just want to make sure I'm not having an audio issue.
Okay, I'm okay. Can you hear me
Oh,
now?
okay. Yep, I'll give you back the screen. You okay?
Yes.
Okay, 1 second. I'm giving you back the screen. There you
And
go.
any questions, I will take them now.
Okay. Somebody's asking, how does your process change when using TPO charts, given that there's no data above the all-time highs?
Well, as I said in the weekend recording, there's not going to be any resistance levels above the market because it hasn't traded there. So the profiles aren't going to change. I mean, you're going higher. Are you getting higher value? You're getting good, good shape, good volume. You don't have any. It's probably healthy because then you're not. So many times people mess themselves up by having targets, and they get targets in their mind, and for some reason they relax and they don't take what's going on in the market a step at a time. But no, it's there is nothing up there, so the market's just the trend is up, and you're looking to see, do we finally get an excess high? Okay, next question.
Okay, we have had several people ask a similar question about, is there an ETA and when your ETA on when the new book will be completed or available?
No, it's we're on.
It's still in progress.
I'm working on chapter 13 today. My guess is there's about be probably about 20, 25 chapters in the book. And usually from the time you submit the book to the time it gets published, it's usually about a year, 9 months to a year. In there, it just takes some time to, package it, do the marketing and all that kind of stuff. Okay.
Okay.
Thank you for asking.
Yeah, several people were asking for that. Okay, Wednesday closed with a spike lower. Would Jim consider overnight inventory to be long and the base of the spike to be possible support for today?
Yeah, I think that's fair. I didn't really think of it as a spike. I know it kind of looks like that. And I guess I was so focused on how slow the market was going down. I mean, it was just agonizingly slow, and it's all I could do to get out the low. What's going on, in my opinion, what's going on in this market right now is that as you know, we break it down into innovators, early adopters, early majority, late majority, laggards. I believe that the majority of buyers in the current market are laggards. Now, those are the people, they've watched the market, and they finally decided it's going higher. A lot of times that communicates the wrong message. People think, well, the laggards, it's got to be over. It is amazing how long the laggards can carry the market. And I'll give you an example. If you take a look at the low for these 2 days, for the 22nd and 23rd, the 22nd low, is just about at Friday's high. We come down on the 23rd, and it traded several thousand contracts here, and I was sure it was going to go through, and it didn't go through. This is not the action of longer term money. Now, there may be some systematic traders buying there, but this is so mechanical that the odds are this is very short term traders, laggard traders. But remember, that can go on for an awful long period of time. The longer term money has a tendency, even if they don't like the market, they have a tendency to say, wait, the market's going up. Why should we get out? Why should we get out here, even if we don't like the market? One of the statements I remember some of these longer term managers saying years ago, I don't like the market. We don't like the market. We're ready to sell, but we're not selling now. But we've got our shoulder in the door. And I always laugh because when you see when these markets finally break, they break really hard. And there's all kind of longer term money with their shoulders in the door, and they're all trying to get through the door at the same time. But it's not illogical. The market's going up. The market's going up, and the trend is up. You're at new highs, and people have a tendency to just say, you know, don't fight the trend. And I said, like yesterday, we have no excess on the high. We don't have any indication that we've got an all-time high in this market. Okay, other questions?
Okay, so we've had more than one question asking about overnight inventory. Would you say that it's neutral or long?
Well, it's the electronic trade is long right now, but I'm not worried about that because what happened is, you know, you got the news this morning. They were trying to sell prior to the news coming. They were trying to sell the market off. Couldn't do much of it. So now, you know, where are we right now? We're going to open here in less than 2 minutes. So we're going to open within the previous day's range. So when you open within the previous day's range, I'm not going to worry if overnight inventory is long or short. What you're going to look for, what you look for at every opening, is confidence. How much is there confidence going up or confidence going down from the opening? Now, you're right smack just a little bit above the center. Here's the center of yesterday's range. You're going to open about the center of yesterday's range. So opening within the center increases the odds that you're going to get chop. Chop is very expensive. The one exception is to chop. If you open and you single print up or you single print down with confidence, that gives you a different atmosphere. But right now we have no excess on the high. The market's not scared off anybody. So remember that even if the market's strong this morning or weak, remember, I don't know what'll happen, but do remember that you have a 7-year bond auction, 1 o'clock Eastern. Okay, what else you got?
Are you looking at the nonstop rise in AI stocks like Nvidia, etc.? It almost reminds me of the 1999 Nasdaq rise.
Oh yeah, very much aware of it. But what you don't want to do is you don't want to front run that. They can go so much longer than you ever can imagine. You know, if you don't personally want to get into them, that's fine. But so many times people lose money because they can't wait. They can't wait to short those stocks. FOMO sets in and they get short way too early. Generally speaking, my rule is when the market's been going up, you are usually better off to be a little bit late getting into the market than early. Too many people are so anxious to be, you know, they don't want to miss it. FOMO, I think the thing I read quite often, and I think the last time I read it was from Denise Scholl, and I think she said, and I think I pretty much agree, that FOMO, fear of missing out, is probably the worst, probably the biggest cause of our losses in the market. And that's why I say a lot of times you're better off being a little bit late rather than a little bit early. Okay. And one thing before I want to talk just briefly about last Friday as the market was coming up to make going after the new high. If you watch the market on Friday, it was just grindingly slow as the market was going up towards that level. And I found myself, you know, leaning into it, wanting to short it because, you know, it was just so slow and grinding. But what you need to appreciate is larger traders and investors understand that the largest risk is as you approach that level. So if I'm a larger trader and I'm looking at risk reward, it is not uncommon that the larger money will be out of the market prior to that high. because if it doesn't make it, they know the risk is very high. So a lot of times what they do, they sell the days coming up to that level. And then if it goes through that level, they come back in, because they come back in, they say there's less risk buying at new highs than there is being long just below those new highs. That's a very common way of thinking for traders. And if you ever, if you think about this, we had a non-excess high last year. Then we came up in January, and the market, a couple times fell short of taking that high. And the market broke back down. So the risk, a lot of these traders realize that the risk is right there, and there's less risk once you take it out. And what happens? Traders do what works and doesn't till it doesn't work anymore. I remember an individual, friend of mine on the Florida Chicago Board Options Exchange years ago, made that statement to me. Traders do what works until it doesn't work anymore. And I kind of laughed it off at the time, it didn't mean much. And as I thought about it, I said how significant that statement is. And it was so obvious when we came up in January, came up just a few ticks short of the, last December's high. Traders were selling because it worked last time. Well, every time they do that, I mean, it's not irrational. But then the larger traders understand that the risk is more risk being long on this side than there is being long at higher prices. Okay. Any couple questions before we call it quits?
I think we're good. I just wanted to clarify and then also mention that for those that sign up early for the intensive, we are having that special session that Jim spoke about at the beginning of the webinar this Saturday at 10 a.m. Eastern, monitoring for continuation to let your profits run and monitoring for continuation when risk has increased substantially. The go-to webinar invites will be going out for that today, a little bit after we get out of this webinar. So I just want to let those people know. We did send out an email about it to early signups, but just want to let you know that the invites are coming shortly after this webinar. So if you are somebody who's been thinking, I'm going to sign up for the intensive, if you make sure you've done the Foundation and Application Market Profile e-course, better yet, purchase the bundle that contains both so you can get a discount and sign up early, preferably by tomorrow so that I can make sure that you're registered and everything for the webinar on Saturday, if that is something you want to join us for. And it's only for people who are signed up early. That webinar will not be available for anybody who signs up after that date. So, okay. If you got any questions, by all means, shoot us an email at dalton@jimdaltontrading.com or give us a call at the number at the bottom of our website, and I'd be happy to speak with you.
Okay, final comment from me. We've opened about the center of yesterday's range. Opening the center of yesterday's range increases the odds you get early morning chop. It's a very narrow range to start with, so don't be too anxious. All right, thank you much.
Thank you very much, everybody. Have a great rest of your week. Bye-bye.